Hi again. This is the second video in the two-part series on how to invest as a non-professional investor. So what is out there that we can actually have access to? And in the last video we went through public markets and saw that all we really can invest in is specifically stocks within the stock market. And now we're going to go through funds, and you'll see that there's a lot more that's actually out there for the non-professional investors like us through funds. So in the video we're going to first talk about, well, what are funds and why to invest in them, and then go through some examples of the four main types of funds and go through one example in each. So the first is a crowd fund, the second is a hedge fund, fourth is a mutual fund, and the fifth is an exchange traded fund. And a lot of words, and I'll go through them in a little more detail, so don't worry too much for now. So the question is, what is a fund? And in very simple terms, it's an organization that pools money together on many people's behalf, such as yourself, mainly non-professional investors, and invest it for you. And they can choose what they're going to invest it in. It can be any type of investment, really, across shares and bonds, and in all types of industries and markets. But usually they'll tell you exactly what they're investing in. And the reason why you would invest in one is because it gives you access to all types of investments that, as we saw in the previous video, is actually unavailable to non-professionals. So you can invest in bonds, in government bonds, or in company bonds, also in private companies where you can't buy and sell their shares. But because a fund is an institution and it has so much money available, it can have access to all these different types of investments that we, with 10, 100 euros or dollars at a time, just wouldn't have access to. So the other good thing is you don't have to decide what you're investing in with the fund. They do that work for you. You're paying them. They take a small fee, a percentage of what you give them to do this investing for you. So it can make life a lot less stressful. So the first example of funds, first of all, is crowd funds. And we mentioned this briefly in an earlier video. It's really just pooling money together for really taking many small investments, and it's usually quite an early stage organization that's requiring this crowdfunding. And it can be debt, so this company is issuing bonds for you to buy, or equity, so you're able to buy a share of that company. And as I say, this is usually an early stage company, and they're usually new businesses yet to prove themselves, so they have to go through this crowdfunding. They can't really just go straight to the stock market. So an example of a crowd fund is One Planet Crowd, and they're based in Amsterdam, in the Tropen Museum, and they have all sorts of projects constantly coming through their website and through their fund, which you can choose whether or not you want to invest in. And I chose a random example here that's already finished, so you can't invest anymore, but you could at one point, and it's called Chateau Amsterdam. So it's the first city winery of the Netherlands, and you can see they were looking for 200,000 euros, and they found them all. 199 people put money forward for them, and you can see the rente, or the interest, they were looking for 6%, and the bonds lasted for 33 months. So again, in this case, it was debt that they were raising. You weren't buying into this Chateau Amsterdam, you were lending them money, and they would pay you that 6% return over 33 months. And something to note about One Planet Crowd is they call themselves a sustainable crowd fund. So they only put forward projects that have some sort of interesting social or environmental positive impact. So the next kind of fund, somewhat by contrast, is a hedge fund. And this may or may not ring a bell for you. They usually are in a more negative bucket of financial terms, and it's a fund that does quantitative investing. So not the most straightforward term, but pretty much they're using algorithms or formulae to invest but trade in the market. So buy and sell really quickly, making small bits of money off, say, buying 1 second, selling the next second, and getting this tiny difference, but doing it on a large scale. And so that's quantitative investing, as opposed to qualitative, where you're actually doing fundamental research into companies or the economy, and that's more what funds, as we'll go into later. Other types of funds do. But so these are really, it's all based on formulae. It's not actually investing so much as taking advantage of these changes. So they're not the most positive, they don't send the most positive example for the financial world. They're actually really generally quite limited to institutional investors. So you probably have to put forward a minimum of 100,000 euros. The reason, because the law is quite strict on them, because most people don't really understand what they're doing, so it's not easy for them to be able to sell to the public. And you're, I think, probably fortunate enough not to necessarily invest. But it's always worth understanding what these terms are, because they may well come up. And just to make it a little more concrete, I've given an example here. This is a Dutch hedge fund called Seymour Capital, and as you can see, they say they're doing quantitative investing redefined, and not worth reading through necessarily all these bullet points, but kind of just shows you how complicated their strategies are, and their strategy meaning how they're investing, and how it's pretty much, you can even see someone at the computer, it's all done behind a computer screen, and they're all doing very complex mathematics to buy and sell. So not something you need to worry too much about, but to know that this fits in and is a different side of investing. But back to something that you may well invest in, and that's a mutual fund. So in a mutual fund this time, it's the qualitative research. They're investing in what I put as a particular theme. So it means that they've chosen something that they want to invest in, be it, well, it could just be as broad as shares, or it could be as broad as debt, but it's usually a bit more specific. So it might be Dutch wind turbine companies, or European solar companies. It can be quite specific, and they can also be buying shares or bonds or both. And they're actively managing these investments, meaning they employ people. These are banks and asset managers who put these mutual funds together. They're employing staff to every day, their job is to choose what this fund is investing in and what it sells, and they're trying to make a return for you, the investor in the fund. And an example I have here of a mutual fund is ASN, the bank from the Netherlands. They're milieu and water funds. So they're investing, as they say here, in companies that sort of being innovative in 4 sectors, as it shows: the water and the environment, sustainable energy, and recycling, and food. So they're doing, because it's ASN, it's a positive impact. And you can also see down on the bottom right here, they put a risk gauge from 1 to 7. So the higher this is, the riskier it is. And any fund, this is for all funds, they have to legally have them. Any fund that's investing in companies as opposed to bonds, equity as opposed to debt, it's usually going to be higher up on the risk factor, because companies it's a little more risky to be, as we've seen before, to be owning a company rather than simply lending them money. So this company is a 5, this fund is a 5, so it's fairly risky, they say. And we can see here what their return has been. So they've been investing in these environmental and companies and water companies over the last 10 years, say. And if you invested at that time, gave them the money to do what they were going to do and invest into these companies, your money would have gone from the equivalent of 100 euros to now being about 220. So you've done pretty well. You've more than doubled your money over those 10 years. And as you can see, that's the equivalent of 8.7% every year. So they've done well. And you can see over the last few months, mainly due to Corona, it's taken a bit of a hit, because a lot of those companies that they invest in would be somewhat negatively impacted. But that's an example of a fund that's very much open to you to be able to invest in. Then the next kind of fund, the 4th one we're going to go through now, is what's called an exchange traded fund, an ETF. And I'm going to go into this and all the other funds in a bit more detail in future videos. And the ETF is a very useful investment for you and for all of us as non-professionals. And it allows you to invest in an index of stocks or bonds. And what an index is, it's a portfolio. We've come across that term before. It's just a group of securities, being bonds or stocks, that represent a particular market or a particular economy. So that can be, an index can be all Dutch companies. They're usually very broad, and they usually contain more than, say, 200 constituents. So it could be an index which is all publicly listed Dutch companies, or all publicly listed European companies, and then also particular ones in the United States. You may have heard of the Dow Jones or the S&P. They're often come up in news flashes. They're indexes, one which represents the 500 largest US publicly traded companies, and another one which is all these industrial companies. So they're indexes that track the performance of companies, their share prices over time. And an ETF allows you to invest in this index. So it's a very passive fund, it's called, because an asset manager has chosen, and the asset manager being the person who puts this ETF together, has chosen an index. So to use the example of the 500 biggest companies in the US, they choose that, and they just use algorithms to constantly be buying the amount of shares needed to replicate that index. So it goes up and down as the stock market goes up and down. So it's a relatively safe way of investing in the stock market, because it takes the average of all of these companies, and it's not so limited to, well, human error to choose the right companies, and also to really concentrate it into particular companies that might do well or badly. No, you're investing in a really broad range, as I said, usually more than a few hundred companies. And you can also be investing in bonds as well as stocks. So you can be investing in the debt issued by companies or governments. And the reason why they're called exchange traded funds, or ETFs, is because they can be bought through the stock market, through the stock exchange. And as I said, I'll go into more detail because the ETFs are not the most straightforward things, but I'll give you an example now of an ETF. So this ETF, or exchange traded fund, does an investment in Eurozone government bonds. So these are all the bonds issued by European countries who are raising money. And the first thing you can see is that the risk level is lower than we saw for the ASN fund. It's 3, because these, as I said, these are bonds, not companies, so it's safer, and they're government bonds. And you don't usually see things much lower than 3 because, well, they don't want to be too legally liable by saying it's a 1 and then they don't do well. So here it tells you a bit of the information about this ETF, and as I said, we'll be going into more detail about them in future, but the main things you can see is they say it's Eurozone government bond fund, the size of the assets they have, so this is how much investor money that they're investing into these bonds on your behalf is 690 million euros altogether from people like you, but so many people. And it tells you here that it's tracking an index, and that index is the Bloomberg Barclays Euro Aggregate Treasury Index, meaning is really just a group of all these European bonds that they are tracking that index, so they're buying the right amount of those bonds on your behalf. And because they're an institution, they can buy those bonds where we can't. So this gives you access to buying all these European government bonds where you couldn't do it yourself. And we can see the performance of this. So it's only been going for about 3 years, but it's done pretty well. And because it's very safe, because these are government bonds, they don't go up and down much like the stock market. It's steady, unlike that ASN fund, which was investing in companies. This is bonds, so you can see even during this corona time, it hasn't come down too much. And if you invested, they put it 10,000 euros, it's now worth about 11,000 or so after 3 years, and that's an average of 3% a year. So the returns are much lower because they're bonds, but it's much safer. So that's compared to the ASN fund of, what do we have, about 8.7% return over 10 years. Then the next kind of ETF is a worldwide stock market one. So instead of investing in all these bonds, like a big group of bonds, you might say you just want to invest in the stock market in general, because you believe that over time the stock market will go up, and you don't want to be choosing particular stocks or giving it to these mutual funds to choose the right companies. You just want to invest in the stock market as a whole. And this allows you to do it. And one thing that they add to just make it a bit more specific, in this case it's a socially responsible investing one, in brackets SRI, and we'll go more into socially responsible and ethical investing in a later video. So it tells you a bit here very briefly. This is Amundi, so they are tracking this index called the MSCI World SRI, so that's World Portfolio of Companies adjusted to be socially responsible, and it gives you a bit more information about that. It tells you that they exclude nuclear power, tobacco, thermal coal, etc., etc. And you can read more about the index and exactly what they do. And this is their performance, so they've done pretty well over time. So they've been going since 2007, this particular index, and it's gone up 5% a year. And that's including this big recession, obviously, in 2008. So even over the last 10 years, when there hasn't been a recession, even including this recent dip for Corona, it's returned 8.6% a year. So it's a really good return. And you can see that the blue one is this one, the MSCI World SRI, the responsible investing one. And it's actually outperformed or done better than the world group of stocks without screening for the responsible investing one. So it shows that actually ethical investing can pay off. You made slightly more. So this is the introduction into funds. As I said, we're going to go into more detail on each individual type of fund, well, especially ETFs and mutual funds. And we'll finish off with this summary, which is quite a useful way of putting things into perspective. So these are really what's available to you as a non-professional investor. On the left-hand side, we have equity, and you can buy shares, and these, as we know, through the stock exchange, crowd funds directly with the fund, mutual funds, you can buy them through the stock exchange or with the fund directly, and ETFs, as I said, were purely through the stock exchange. Then you have debt on the other side. Obviously, there are no shares because you're not buying a share, you're simply lending money to something. And you can't buy that through the debt market. So you have to buy it through a crowd fund. You can lend money to a particular initiative in a crowd fund. You can buy debt through a mutual fund, which is lending money. And that's again through the stock exchange. You're buying into this mutual fund or directly with the fund. And finally, you can buy it through an ETF like that Eurozone government bond. And in that case, you buy this ETF through the stock exchange. So thanks very much for watching, and I look forward to seeing you in the next video.